Hi, I'm Greer, an investment specialist with Schroders Australia, here today to talk to you about the Schroders Specialist Private Equity Fund. The market dynamics in private equity are quite unique. It's not just what we do see in the newspaper. Ultimately, there are different market segments such as the lower middle market, the middle market, and large cap private equity. In these different segments, we actually find that there's a different amount of capital that's chasing each of the businesses, and with that, you find that different supply-demand dynamics play out. As you can see in the diagram in front of you, we actually have found, based on our research, that the majority of the capital is sitting in the large cap part of the market, and there is much less capital sitting in the lower middle market and smaller parts of the market. So with that, what we have found is that being in our market segment, we have the ability to be more of a price maker, and we're selling into a market with deeper pockets because the majority of the capital is there, leading to it being a bit more of a market where they have to be price takers. On this diagram as well, you can see that the majority of large cap buyout capital has been raised in the short term, mainly over 2021, 2022. And with that, you actually can see that the market is somewhat overheating, going well over where we see that long-term trend line to be. You can also see on the small to mid-cap part of the market, again, the segment that we invest in, that the market is a lot more healthier as far as capital raised. With that, it means that valuations aren't kind of running away, which we are seeing in the large cap part of the market because people are forced to bid against each other because everyone is looking to deploy these funds. And in that smaller part of the market, you can see that we are still seeing valuations that we find attractive. So we touched on before in the newspapers recently, I'm sure everyone's seen a story that in some way it talks to the struggles of private equity over 2023, 2024. It hasn't been our experience because of the market segment that we do invest in. So you can see on this diagram here, this is an example of some of the exits that we've made in recent years. These are our best exits to date. If you look at the dates at the bottom of those boxes, you can see that some of the dates for the best exits that we've had are in 2023, which is in contrary to what we've seen in the media recently, where there has been some examples of the struggles of private equity. It hasn't been the case for us, really due to the market segment that we are investing in. You'll also note when you look at how we've exited in those that none of them are to IPO because we're not relying on the IPO market. Because the businesses that we're investing in are small enough, we actually find that other companies or other private equity funds are able to purchase them from us. So to cover off what the investment strategy is, so it's 100% private equity invested across the US, Europe, and across Asia. We really focus on investing in the Western world from the perspective of the economy has matured. Majority, it's an aging population, which makes things such as healthcare really attractive, as we have older people with high disposable incomes that are able to that are required to invest in their health as they get older. And then in Asia, where we have a growing middle class, we find some businesses like consumer a lot more exciting. We've been investing in private equity for over 25 years, and we've formed this semi-liquid structure to give the more retail investor the opportunity to invest without the traditional constraints of private equity, such as illiquidity. So the fund constantly invests across secondaries, co-investments, and primaries, i.e. other private equity funds, with monthly subscriptions for investors and quarterly redemptions for investors as well. So we have an AUD, an Australian dollar feeder fund that is available for investors. And we ultimately decided to put no performance fees on the vehicle because we felt that was the best alignment with our investors. So some of the sectors that we invest in, I touched on it a little bit before. So we invest across healthcare, technology, consumer, business services, industrials, but the lion's share of that portfolio is sitting in healthcare and technology. As I said before, Western economies, aging population, healthcare is very attractive. The mission statement of this fund is really to produce a non-cyclical private equity return as much as we can. So with that, things like healthcare are very attractive, but we also have technology as well. Now, when we talk about technology, what we really mean is mission critical technology. So it's going to be businesses that are that require technology for BAU. So you can think of like enterprise resource planning, accounting softwares, really things like Microsoft 365, which would be great if it's in the portfolio. Unfortunately, it's not, but that's the type of business that we're looking for. A lot of software as a service businesses that are required for BAU. The portfolio allocations as of the 30th of November, you can see that the majority of the portfolio is still in buyouts. To date, that's the profitable part of private equity companies. So as you move kind of down to the counterparts there, growth capital and venture capital, that's where we have some of the less profitable companies, but ultimately are capable of creating those outsized returns. As we said before, we're aiming for a more non-cyclical return, as a lot of our investors are familiar with. So we're really aiming to hold majority buyouts, and that's linked to the geographies you can see there in Europe and North America. Ultimately, the places where we find that we have that aging population, mature economy play out, a lot more predictability, is where we like to invest with a high allocation to healthcare and technology. You will note that we do have some allocation to consumer and business services as well. These are more linked to the Asia part of the portfolio, where we do see that growing middle class, and we aim to invest in that geography as well. So in the last portfolio update video, you may remember that Claire Smith, head of private asset sales in Australia, talked about Essential Pharma, a co-investment that we did have in the portfolio. It was one that we're really excited about. It's actually one that we've just exited with a very attractive return. We ultimately received 3.1x our money. We chose to double down in December 2023. And we actually found that we got a 26% return on that double down as well, which we've just exited as well as of December 2024. So a quick refresher on Essential Pharma. It was a business that would specialize in generic pharmaceuticals and would also wait for patents to roll off on medications so that it was able to purchase those patents and take them for themselves. So overall, it was a very a high cash conversion business. It was very attractive, and that's ultimately what gave us that conviction to double down on it. What we're looking forward to as one of the next exits in the portfolio is Innit, which was a European co-investment that we invested in. It's a leading digital services brand that focuses on transformational services. So maybe if a business doesn't have cloud or it doesn't have a strong SaaS integration, they can come along and enable that business to become more tech-enabled. And with that, we've seen that company do very well. Ultimately, it was a 6.2x return for us when we invested in it in November 2019. We then chose to roll our stake forward in March 2022. And since then, we've seen a 2.23x return on it. So with all these numbers, the performance of the portfolio has been really strong. You can see on the calendar year to date performance on the right-hand side that every year to date, we've met the target return of over 10%, which has been fantastic. And it's been with minor drawdowns across the portfolio. On this slide, you can see the representation of the portfolio. So this, if your eyes follow the bottom axis there, you can see different numbers: 0.2 to 0.8, 0.9 to 1.1x, 1.2 to 1.1, etc. So 0.9 to 1.1, what that means is effectively what we paid for it. So 1x would be cost. Anything below that would be a loss to the portfolio. Everything over that is a profit to the portfolio. So with such strong performance, it does bring up the question, is the portfolio just marked up and sitting at a rather high level? But it's too late to join the party. You can see here that the majority of the portfolio is still sitting early in its valuation creation journey. Between 0.9 to 1.1x, if you look at the bottom axis there, that's really around cost for us. That's essentially what we paid for the company. So anything to the right-hand side of that is essentially a profit, and anything to the left is when it has a loss. Of course, it has the opportunity to still bounce back. So we're staying hopeful on some of those companies, but the vast majority is on the right-hand side, which is fantastic. So for our market outlook, I thought it'd be good to get up the 5 biggest market disruptive events of the last 25 years. A lot of them will be familiar: the dot-com crash, the GFC, the Eurozone crisis, and the COVID-19 outbreak, as well as the period that we went through recently, which we'll call the return to inflation for now. Across the aggregate of private equity, we saw outperformance relative to MSCI All Country World. What that really means to us and the way that we consider our asset class is that it provides a diversification benefit, especially during periods of drawdown, which is when you really need it. So another way of looking at this data is also looking at the breakup of the different private equity segments that we talked about before. So considering small buyouts, mid buyouts, and large buyouts, and the way that we saw drawdowns across the GFC, we actually found the market segment that we're in, small to mid buyouts, experienced the least amount of drawdown. The main reasons around that are due to the lack of leverage or the lack of requirement of leverage in small to mid to generate a return, as well as not needing to access and exit via an IPO, as we discussed before. More importantly, you can see that the MSCI All Country World Index during the GFC had substantial drawdowns relative to the segment that we're in. And you can see on the right-hand side there that the entry multiple that we invest in, which is the navy line there for small buyouts, is substantially less volatile than what we saw in large buyouts. So that means that we can consistently invest through these periods of market disruption without seeing too much of a change in the valuation that we're investing in. So we've covered a lot today. I think the main messaging that we wanted to get across is we're very confident in the long-standing strategy of our portfolio. What we find is good supply demand dynamics across the board in our market segment and what we exit into, being more large cap. We have a large universe of target companies, so we're able to find these diamonds in the rough. Our performance isn't through leverage, it's more through transformational change, so we're not as reliant on interest rates. We focus on businesses that are also able to pass through inflation, which makes them more non-cyclical, such as healthcare or mission-critical technology. And as I touched on before, we have a low dependency on debt financing. So that summarizes the presentation for today. Thank you for listening and enjoy your day.